Hello to everyone. Today I am going to start a new topic. It's financial risk management part 1. If you are interested to have more videos on banking and finance related topic, please do subscribe my channel. The title of the course is divided into 3 parts. First of all, financial, second one is risk, and third one is management. The word financial derived from finance, managing money resources of a state, company, or a person. Resources means all type of tangible and intangible asset is to liability. Risk is defined as uncertainty, that is, as the deviation from an expected outcome. On one side, risk is deviation. On the other side, risk is related to the damage or the loss. Management is defined as the utilization of available resources for the accomplishment of organizational goals. Risk can also be defined as any source of predominance that may have an adverse impact on a person or a corporation. Adverse impact can be in the shape of loss, damage, or any type of return less than its expectation. Risk management is about how the firm activities select the type and the level of the risk that is appropriate for them to assume. In other words, risk management does not mean risk minimization. You will have to manage the risk. Here we have two examples. First is related to the expected loss and second is related to the variance. A situation is riskier than an other one. There is a greater expected loss. A young male driver are riskier than middle-aged drivers. So here we can say the expected loss can be on the greater side in case of a young driver. There is greater variance, less predictability of outcome. A biotech stock is riskier than a utility stock. So these two examples may bring clarity in your mind. There are two types of risk. First of all, business risk, and second one is financial risk. Business risk that the firm assumes through its daily operation and include the risk that result from the business decision and business environment. So here we have on one side business decision and on the other side business environment. Strategic risk related with the decision and economic risk related with the environment. Strategic risk reflect the inherent in the decision of senior management. Macroeconomic risk impact a firm's operations and sales. The ability to effectively manage business is a core competency for a strong firm. One of the examples of the business risk is due to economic slowdown. The demand for the product will fall. So it has a great impact on the operations and the sales of the company. It's a process. For example, in case of economic slowdown, uncertainty created within the environment that lead the purchaser to minimize their consumption of funds, that leads to cut down in their purchases. And definitely when the purchases will cut down, the finished good will pile up. When the finished good will pile up, the industry will have to minimize their production. And over the period, that may lead to the unemployment when they start layouts within the organization. Further, There are two types of the risk. One is the internal risk and other one is the external. Internal risk related to the people's risk, process risk, technology risk. External risk related to financial risk, non-financial risk, and technology risk. So technology risk is the part for the both internal and external. Risk is costly. Greater risk involves cost, reduce value. For example, identical property subject to damage. Greater expected property loss lower the value of the property, all else equal. Now, where we have the chances of the damage, for example, it depends on your location. Sometimes there is a drain, and due to drain, the property used to, or there are the chances of damage to the property, particularly equipment like inverters, air conditions, and their grills. So that chances of damage usually reduce the value of the property. Second, greater uncertainty about the property loss often lower the value of the property, all else equal. So in this case, the area like you are near the river, there are chances of the flood, maybe after 10 years, maybe after 15 years, but that uncertainty definitely affect the price of the property. Importance of indirect loss. Direct loss often cause indirect loss. For example, if you have a damage within your property, you may have to vacate the property and go for a rented out for a short period. So in this way, the direct loss to the property cause an indirect loss to you as well in the shape of paying rental. Trade-off in the cost of risk. Decrease one component of the cost of the risk usually is associated with an other with an increase in the other component. For example, decrease expected direct loss, workers' injury cost by increasing the loss control, increase the workplace safety. So here you are decreasing one loss, that is direct loss related to the workers' injury. For example, you feel that most of the workers having hand injury, you start providing them special gloves, so that the cost of the glove is a part of loss control cost. So on one side you decrease workers' injury, on the other side you will have to bear the cost against the gloves you have provided. Secondly, decrease expected indirect losses, bankruptcy costs by increasing the loss financing cost that you pay against the insurance coverage. Decrease the cost of the residual uncertainty by increasing the loss financing cost, that is insurance. So insurance is one of the way of risk transfer. Key points from the example: do not minimize risk, minimize the cost of the risk. There are cost trade-offs. Basically, risk management is risk is to cost trade-off. Increase insurance coverage, increase loading paid, decrease residual uncertainty. For example, you ask to have a coverage against vehicle damage. So the loading may be equal to 2.5%. If you said, I also require the coverage against the theft, the loading will be increased. And thereafter, you also ask for the damage coverage. So the loading will further increase. So definitely, it will decrease the residual uncertainty. Additional loss control, decrease expected loss and increase the loss control losses. Like in the previous example, when you provided the gloves, it decreased the expected loss. And on the other side, there is an increase in the loss control cost. Investment process deal with the risk return trade-off. No risk, no return. Taking one more risk is sensible only if it results in a greater likelihood of a greater reward. Appetite for the risk determine what reward on sale. Risk management process deal with the risk cost trade-off. Do not minimize risk and minimize the cost. Whereas risk and return trade-off deal with the on one side, the higher the you have the reward, you will have to keep in mind the higher chances of the losses. Thank you very much. See you again with the second part of risk, financial risk management.